While disinformation and accusations fly over the cause and the handling of this disaster, the people on the ground losing their houses are in survival mode, trying to pick up the pieces. For them, these fires have been personally and for some financially devastating. The overall total damages caused by these fires is unknown as the disaster is still being contained, but it's estimated to be around $150 billion, the largest natural disaster in the state's history and potentially the country's history. All this while last summer, State Farm declined to renew fire insurance for 30,000 California homes, including 1,500 homes in the Pacific Palisades, citing increased exposure to catastrophe. Past fires have resulted in net losses for home insurance companies in California, so this change has been long in the making. Numerous other insurance companies pulled out of California before State Farm. Newsweek recently reported, according to the California Department of Insurance, 7 out of 12 of the Golden State's top insurers cut coverage in the state over the past 4 years. And those who were refused fire insurance coverage have little legal recourse. According to Newsweek, the law usually cannot force an insurance company to undertake the risks of offering insurance to anyone unless the insurance company voluntarily agrees to take on the risk and offers insurance coverage. State Farm decided not to renew fire insurance coverage. They didn't cancel it in the middle of these people's policies, so contractually speaking, they didn't break any contract. They just didn't renew, which is legally in their right. This is why what is right and what is legal are two very different things, and why we need laws and regulations regarding insurance companies, because they will operate in whatever way is best for their bottom line unless the law requires them to do otherwise. According to Newsweek, California's law prevents insurance companies from non-renewing homeowners in and around a declared fire emergency area for a year after the fire. So now State Farm or any other insurer can't turn around and cancel coverage for people living in the area in reaction to these fires, at least not for the next year. But there doesn't appear to be anything stopping them from denying coverage elsewhere and then pouncing the moment that one-year ban is up to deny coverage across the board in California. According to the New Yorker, until California state rules were revised last year, they prevented companies from using so-called catastrophe models to forecast losses from wildfires. Insurers could only look backward at historical losses. Also, until last month, they could not pass on the cost of reinsurance, which is basically insurance for insurers, and which has been rising steeply in price. Now, because of changes to the law, insurers can base coverage and prices on future estimated losses, which catastrophe models show will continue to increase. And insurance companies can now pass the costs of their own insurance on to their customers. What a tangled web of trash. The one recourse that some in California have is a state-led insurance effort called FAIR. According to the New Yorker, as insurers have pulled out of California, the number of policies written by the state's FAIR plan has risen steeply. Just since late 2023, it has grown by more than 40%. Meanwhile, the value of the residential properties insured by FAIR has risen to more than $450 billion, triple what it was in 2020. This has led to worries that with all the damage from the current fires, the plan will go broke. Were FAIR unable to meet its obligations, the state's insurance companies would have to make up the difference. They, in turn, would pass on at least part of the cost of this assessment to consumers, further driving up prices. And the cost even of FAIR coverage can be too high for some homeowners. The Los Angeles Times reported that one homeowner had his farmer's insurance plan raised from $4,500 a year to $18,000. And when he looked to change to the FAIR plan, which has fewer benefits, he would have been required to cut down 10 trees on his property to improve fire safety, which was also too costly for him. I don't know how much it costs to cut down a tree in LA, but in Minneapolis, to just get a tree trimmed is like $2,500 for one tree. So he decided to forego insurance on his Pacific Palisades home and then lost his home to these fires. And this is an impossible decision that more and more homeowners are facing as the rising cost of home insurance makes owning a home, something already prohibitively expensive, even more expensive in these disaster-prone areas. They're seeing similar insurance issues in Colorado, where wildfires are also a growing threat, as well as Florida, Louisiana, and Texas, where increased hurricanes have made finding home insurance increasingly hard. So the issue of getting a home insured is becoming a bigger obstacle in areas across the country, all while homeownership generally is becoming less attainable for more and more people.